Do you think we're in a major bubble now, right now in the United States? And do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
Throughout his over 50-year career, billionaire investor Jeremy Grantham has developed a reputation as somewhat of a doomsday oracle. He has become famous for predicting some of the biggest stock market crashes of all time, such as the dot-com crash in 2000, the financial crisis in 2008, and most recently, the tech bubble in 2021. Here in 2023, the U.S. stock market is once again bumping up against all-time highs, and this has Grantham warning that the market is dangerously overvalued. Here's what he had to say.
You were well known in the investment world for saying that sometimes there are bubbles and bubbles should be avoided. Do you think we're in a major bubble now, right now in the United States? And do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe...
It may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer.
Right.
You disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
Now, you said not too long ago that you weren't a big fan of Jay Powell and the way he's been handling inflation. Is that correct?
Yes, that's correct.
And you think he's done a better job recently in getting inflation under control?
I think it's largely out of his hands. The forces work. I suspect inflation will never be as low as it averaged for the last 10 years, that we have re-entered a period of moderately higher inflation and therefore moderately higher interest rates. In the end, life is simple. Low rates push up asset prices, higher rates push asset prices down. And we're now in an era that will average higher rates than we had for the last 10 years.
The U.S. stock market has done really well for almost 15 years. Look at this chart. It shows how the S&P 500 index, which represents the U.S. stock market, has gone up. In February 2009, it was around 1,000, and now it's about 4,500. This has been one of the best times for stock market investors in the past 14 years. But some people, including Grantham, are worried that the market is too high and might not be able to stay this way. One big reason for the market going up so much is that interest rates have been really low in the U.S. for most of the last 15 years, almost close to zero. These low rates have been like super fuel for the stock market. Let me explain. To really understand what Jeremy Grantham is talking about, let's talk about how interest rates affect the value of things you own that make money for you. These things are called assets, like stocks, bonds, and real estate. When we figure out how much an asset is worth, we think about how much money it will make for us in the future and bring that money back to today using an interest rate. It might sound tricky, but it's not so bad. Imagine you have a stock that makes $30 every year for 10 years, and after 10 years, you can sell it for $300. You know how much money the stock will make for you, but we need to figure out its value today. We do this because money today is worth more than money in the future. Here's a simple question to prove it. Would you rather have $10,000 today or $10,000 in 10 years? You'd choose $10,000 today because it's worth more now. This is called the time value of money. For this example, let's start with a 20% interest rate. At that rate, the stock is worth $174 per share. Now watch what happens when we lower the interest rate. At 15%, the stock's value goes up to $225. If we drop it to 10%, the value goes even higher to $300. And at 6%, it skyrockets to $388 per share. Notice that the money the stock makes doesn't change, only the interest rate does. Lower interest rates made the stock go from $174 at 20% to $388 at 6%, a massive 123% increase without the stock earning any extra money. This shows how low interest rates can make stock prices shoot up. But it's not just about numbers. Human behavior plays a role too. Grantham explains it like this.
Likely to go into a recession probably next year, though it could start this year, that the tech bubble burst that we saw beginning, let's say, last year has not yet completely played itself out.
Right.
And we have a little mini bubble a bit in artificial intelligence.
In a way, not so many. They were very big moves in a dozen very big stocks. And
well, mini in the sense that it's not affecting the overall economy as much as the whole tech
No, that's
world
right.
did.
In comparison to 2021 and 1929, it's much
So
smaller.
what is it about human nature that makes them feel they want to participate in a bubble? They see the stock market going up and they think they're going to miss something. Even the famous Sir Isaac Newton participated in a bubble.
Yes, he did.
When he thought he was missing something. He mortgaged his house and put all his money into the South Sea Corporation and lost all of his money. So even somebody as smart as that was unable to resist the bubble. Why is it that humans can't resist being in bubbles?
I always like to say there's nothing more supremely irritating than watching your neighbors get rich. It is just irresistible to try and join in. And when enough people hit the inflection point, it sucks in everybody. And they're the great bubbles. They're the ones that are interesting. Mostly there's a nice balance between bulls and bears. And once in a blue moon, every 20 years or so, you'll hit an inflection point where enough people become bullish that people stop thinking about fundamentals.
Bubbles happen because people get scared of missing out when they see others making lots of money. This has been going on for as long as there have been financial markets. J.P. Morgan, a big shot banker from the early 1900s, and the guy behind J.P. Morgan Chase knew this well. He saw markets go up and then crash many times. He once said, seeing your neighbor getting rich messes up your financial judgment. Even really smart folks like Isaac Newton can get caught up in the idea of making easy money. And let me tell you about Newton. In case you don't know, Isaac Newton was super smart. He's the guy who figured out how gravity works, invented calculus, and came up with the laws of motion. But even with all that brain power, he lost a bunch of money during a financial bubble. Back in 1711, he put a lot of his money into the South Sea Company, a British company that promised big profits. At first, he made a ton of money as the company's stock went way up, but then he got greedy and risked everything by borrowing money to buy even more stock. In 1720, the bubble burst and the South Sea Company's stock crashed hard. Newton's investments turned nearly worthless, and he lost a lot of money. Newton famously said, "I can calculate how things move in the sky, but not how crazy people act." Even a genius like him couldn't escape the chaos of the financial markets. So if Isaac Newton couldn't avoid a bubble, how can we? Luckily, Grantham has some advice on what to do next.
So if I said to you, look, I'm not that wealthy, I have $100,000, I'd like to put it somewhere where I'm not going to lose it, what would you recommend a person? Just an index fund or something else?
No, I think a global index fund that had most of its money outside the US. And if they were up to it, I would say only invest outside the US for the time being. Because this overpricing in the market is mainly a US event. The markets outside the US are not particularly overpriced.
Grantham thinks there's a big bubble in the U.S. stock market. One way to figure out if stocks are too expensive is by using something called a P/E ratio, which stands for price to earnings ratio. Think of it like this. If you pay $20 for a stock that makes $1 in profits, the P/E ratio is 20. It means you're paying $20 for every dollar the stock makes. The higher the P/E ratio, the more expensive the stock, and the lower the ratio, the cheaper it is. This can apply to entire countries' stock markets, too. Let's compare P/E ratios for different countries to see if Grantham might be right about the U.S. being too expensive. Right now, the U.S. stock market has a P/E ratio of 22, which is one of the highest in the world. India's is even higher at nearly 24. Now let's check how the U.S. compares to other big economies. France is at 16, Australia at 15, Canada and Japan are around 14, Germany is about 13, the United Kingdom is 10, China is 9, Italy is 8, and Brazil is 6. You can see there's a big gap between the U.S. and these other countries, supporting Grantham's idea that U.S. stocks are expensive. But there's more to it. The U.S. has many huge and profitable companies, and lots of people worldwide invest in them, which drives up the prices. So, we also need to look at how the U.S. P/E ratio compares to its past. If we use the S&P 500 as a measure, its P/E ratio is similar to what it's been for the last 30 years. So, maybe Grantham is wrong, and U.S. stocks can stay this way for a while. That's the story. Thanks for watching. Subscribe for more weekly investment tips. Leave a comment below. Happy investing!